Welcome to Bar Chart's series of webinars designed to educate you about a variety of market concepts, to inform you of the features and tools Bar Chart provides related to these concepts, and finally to offer you some trader's insight to help you make a more informed investment decision. Today's session, Volatile 2022, provides clues for opportunities in 2023. Now, market volatility and conflicting economic data and an aggressive Fed tightening policy, to say the least, has left investors battered, bruised, and bewildered in 2022. And 2023 is shaping up to be just as confusing. Yet, in the past few months, the market is starting to show through sector rotation that is shedding light on maybe what could be a clearer way to outperformance in 2023. Hello, everyone. My name is John Rowland, Bar Chart's Senior Market Strategist, and today we're going to explore the investment strategy of sector rotation while incorporating market cycles with economic data. Now, before we get to that, please welcome my partner and our moderator, Bar Chart's Project Director, Gene Baker. Happy holidays. Merry Christmas, Gene.
Happy holidays to you too, John, and everybody else out there that's joining us today. Happy holidays.
Yes, exactly. So what fun-filled
Happy hump day
do you have for me today?
Oh, gee, you know what? I don't have one for today other than happy holidays. That's it.
I got one for you.
Okay.
Today is the winter solstice.
That you're right. The longest day of the year, the darkest day of the year,
the shortest day of the year. Yeah, so it's all good from here, right? Because for every day from now, days are going to start getting longer and longer, and we get closer and closer to summer.
That's right. That's right.
Okay. You ready to get started, Gene?
Yeah, let's wrap up the year with a great webinar today, John. Let's go.
Let's do it. All right. So how do we make sense of all this? How do we make sense of charts like this spaghetti chart in terms of sector performance? Or what clues can we look for from past performance to find the next investment opportunity? Well, it all goes back to, well, actually, you know what? Let me stop for a second here and just make sure everybody realizes today's session is for educational purposes only, and that the decision to buy, sell, and hold securities is best made for advice from a qualified financial professional, and that the material that you're going to receive today, that under no circumstances shall we be liable for those damages or from trading activity or investment activity engaged based on information or material you receive through Bar Chart or Bar Chart service. So sorry about that. I forgot to do that disclaimer. So again, how do we decipher what is going on from past performances and maybe give us some clues for this coming year? So it goes back to some work that was done by Sam Stovall in 1996, who came up with this idea that sector selection and market performance were related to economic conditions and also market cycles. Now, this is a kind of a simple concept, but this has really been the roadmap for investing for over, let's say, the last quarter century, probably even longer period of time. It's just Mr. Stovall put this down in a paper in the book. Now, Stovall also identified 5 market cycles: early expansion, mid expansion, late expansion, early recession, and late recession. Now, later on, John Murphy, in his book, Profiting from Global Market Relationships, built upon Stovall's concepts, and that there were 2 cycles that we needed to be to consider: market cycles, which is basically just the rhythm of the stock market, the ups and downs, the bull and bear trends, and the economic cycle, which is really that driver which defines economic condition, the robustness of the market. Now, Murphy concluded that the market cycle leads the economic cycle by about 6 to 9 months. So, in other words, the stock market is always looking forward. So, Murphy proposed this graph. So, let me kind of walk you through this graph. So, here's the black line, this black hump here represents our market cycle. And the gray line represents our economic cycle. And you can see on the bottom here, as our market cycle moves from market bottom to bull market phase, to market top, to bear market phase, and back to market bottom. And then you can see in the gray, we go from full recession to early recovery to full recovery to early recession. So you can see it here that the market cycle, according to Murphy, is forward or happens before the economic cycle. So looking at this graph without really knowing, or let's say guessing, just bear with me here, where we are currently in this cycle, let's just concentrate on the outperformers or the sectors that we're going to look at in each one of these cycles. So we can see here, let's start with energy. And energy, right, is the outperformer at the market top. And as the economic gets to full recovery. But let's move forward too. So staples and services are ones that are going to outperform as the economic cycle reaches its top, but as our bull market starts to move to a bear market. And then as both of these turn down, both of these cycles turn down, then there'll be a shift to utilities and finance or financials. So let's go back to our market performance. So here's the year-to-date of the major market sectors of the S&P, and we can see here that the S&P energy sector, this is not anything you guys shouldn't be aware of, right? The energy sector has been the best sector this year. So according to Murphy's chart, what we know now is that the energy sector is telling us that we were at a market top, or we were at the full recovery of a market. And now what is happening? Well, in, let's say, the last 3 months, right, energy is still kind of outperforming, but not as much as all the other sectors like it was year to date. We do see other sectors here are now starting. We see a little bit of industrials and materials. I think those will be outliers. We'll address that a little bit later. But we can see now financials and healthcare and consumer staples are starting in the last 3 months, are starting to show signs of performance. And if we look at what has happened in the last month, we can see that continuation of consumer staples, healthcare, and now we see utilities has popped up. Now, 6 months ago, utilities was one of the lowest ones. 3 months ago, see, utility was one of the underperformers. And only in the last months have we started seeing utilities start to pick up. So we think about Murphy's graph, right? It's kind of telling us, based on the market rotation, where we are in that market cycle. Go back to that. So we see energies was at the peak, staples, Now, services, when we talk about services, we're really kind of talking about business services, but at the consumer level, you can think about like airlines and uh, travel and leisure, hotels, cruise lines, things like that. And those actually have been some of the stocks have been doing well, let's say in the last 3 months, 6 months or so. So what we're now seeing is where are we in the market cycle? Well, again, if you hadn't seen a chart, you didn't know what a chart looked like in terms of the overall market, we would say that we're in the bear cycle, and that is exactly where we are, right? And we look at the S&P. This is just a line chart of the SPY, which is the ETF that represents the S&P. You can see that, we are in a bear market, is a well-defined bear market. So we know where we are in the market cycle, and the economic cycle has been giving us mixed signals for most of the year, but the sector rotation is trying to give us that clear signal of what sectors that we want to start concentrating on. So after Murphy, though, we had the Conover Group research group, and they focused on the Fed policy, the effects on sector rotation. And they defined sectors into two groups, the cyclical and the non-cyclical. Now, this is a kind of a term that gets thrown around a lot, certainly in the media and analysts, cyclical stocks and stuff like that. So let me kind of just boil this down to the bare minimum. And again, I'm just kind of making this simple. Basically, a cyclical stock is a stock that moves with the market, and a non-cyclical stock is one that moves on its own. Now, in other words, cyclical stocks are usually your high beta growth stocks, and non-cyclicals are your low beta value type stocks. And that's really boiling it down. That's as simple as it gets. I mean, it's a little bit more complicated, but that's really what we want to concentrate on. So where are we in the Fed cycle? Well, we know where we are in the Fed cycle. The Fed has been raising rates aggressively this year. So we're in a tight monetary policy, rising rates. So according to Conover and his group, what are the sectors that we want to start concentrating on? Well, we want to start concentrating on these non-cyclical sectors, excuse me, say that 3 times. So resources, again, I think that would be that outlier of our materials and maybe some of our industrials. But consumer staples, right? Consumer goods. We noticed that in the opening. Our non-cyclical services. Now, non-cyclical services could be a wide range of industries, healthcare, insurance, utilities. So let's do this. So I went to our page, our major market cycle page. And if you don't know where that is, you go on the stock page here, and down here where it says sectors, sector, market sectors. And again, I'm kind of just looking at a 3-month, what's happened over the last 3 months. Remember, our market cycle tends to lead, and also we believe in momentum theory that it's going to lead, 6 to 9 months out. So if I can find stocks that are outperforming, let's say in the last month, the last 3 months, then I know that those are the ones that are going to probably outperform for the next 3 months to the next 6 months. And there's our materials there. That was one of the sectors that has outperformed in the last 3 months. So what stocks are in that group? So I just clicked on the sector, and these are the stocks that are in that sector. Now, again, if I go to my main view here, I'm going to just look under performance. And again, I'm just going to look at which ones have outperformed in the last month, right? Sort of those outliers. And, look at some of these stocks. We got Freeport-McMoRan, Air Products, Newmont Mining, International Flavors and Fragrances. So there's a few stocks here we can kind of look at. Underneath performance, I'm going to go to fundamentals. And there's our beta, right? That relationship to the market. What did Conover's group say? Well, we want to look for non-cyclicals, right? Those that have low betas. So which are the ones that are outperforming? Those in the material group. Well, Air Products, below 1, a low beta. Uh, International fragrances, right around 1, kind of a neutral beta. Um, Newmont Mining, very low beta. Now, Freeport McMoran has a high beta. Okay, so it's not always consistent, but there is some element to what we're seeing, what Conover Group was expressing, and we're seeing that in the market. So they also talk about consumer goods, staples. So let's do this on this way through our analysis. Let's go to our major market heat maps. And I'm going to go to our consumer staples. I don't want to look at today's results. I'm going to start, let's say at that 3-month time frame, right? Somewhere between peak market top and peak economic top. That's what we saw on that graph of Murphy's. And what are some of our outperformance? Well, we got Procter and Gamble, a very kind of conservative stock. Coca-Cola, Pepsi, Mondelez, uh, Monster Beverage, uh, Archer Daniels, the supermarket of the world is their advertisement. Kraft Heinz, right? Very low beta, conservative, large chip, blue chip stocks, right? Those are the ones that have been outperforming that in that particular sector. So we also talked about looking at healthcare. Again, if I go to the healthcare, it's what we've noticed in the last 3 months or so is, our large cap pharma, Eli Lilly, Merck, Moderna, right, Gilead, right. So these are those true steady type stocks. But also, what did the Conover Group said? Well, insurances, right? So we're in the healthcare sector, and we are starting to see some of the insurance type healthcares, right? United Health Group. I think Humana, I think I saw when I was looking this morning. I check my glasses here. Yeah, Universal Health Services, another more of an insurance type. Cigna, there you go. So, oh, there's Humana. I didn't see it was hidden right there. Again, those are those non-cyclicals, in this case, insurance companies that are in the healthcare sector. So we talked about insurance now. So where can we find some insurance stocks? Well, insurance stocks usually fall under the financial group. And we do see some of our major banks. Here's JP Morgan and Goldman Sachs. Those would be in our financial group. But, look over here. AIG, insurance. Aflac, insurance. Travelers, insurance. So these are the groups that are outperforming. These are the ones that are outperforming the market, right? Everybody's always worried about this market, this bear market. But yet I'm showing you a lot of sectors. Inside of these sectors, a lot of stocks that are not only not acting like a bear market, but they're actually outperforming the greater market. And, Berkshire Hathaway. So if you're not familiar with this stock, Warren Buffett, if we just click on this and we go to the Berkshire Hathaway page and we look at what businesses that Berkshire Hathaway is in, I mean, they have a lot of businesses, but you can see it says down here, their most important are these in the insurance business. And that they show you that they are in a lot of different types of insurance companies. So here's another stalwart uh, blue chip type stock that is in the right sector at the right time based on the theory of market cycles and sector rotation. And let's look at one more. And that's utilities. That's the one that has been growing. That's the one that in the last month is starting to pick up, right? That's the one that is the sector, if we remember from our chart, is the one that is going to be in the bear market and the downturn of our economic cycle that we want to look at. So here I'm in utilities, and we'll look at the last month or so. A couple of, energy companies, your typical public utilities, Exelon, Excel, public service groups, right? Very conservative, very low beta, right? Value stocks, not growth stocks. So now the question that comes to mind is, all right, so we know where we are in the market cycle. We know where we are kind of in this economic cycle. Where or when, how can I determine when our market is at the bottom or the end of our bear market, and when our economic cycle is gotten to, let's say, full recession and is ready to start turning to early recovery? Well, I think we can agree we're not there yet. Certainly, I think we can think about next year is going to probably be the recession type year. But at some point during next year, or maybe at the end of next year, we can start thinking about these sectors, the cyclicals, the technologies and industrials. Those will be the next sectors. Remember, the market is always looking forward. So those are the sectors that we want to kind of concentrate on when we get that information that tells us that there's a change in our economic cycle, but the market cycle is anticipating that. So how do we do that? Well, we have economic indicators, and you've probably seen these on TV. You've heard the Fed talk about them. So there are three categories. There's leading economic indicators, there's credentials, and there's something called lagging economic indicators. So let's kind of just briefly go through these. So length of manufacturer work week, right? We want to see our work week get longer, right? That's kind of telling us that our manufacturers know that their orders are coming in. They're thinking positive about creating new goods and services. Now, this one has actually been strong for most of the year, but I think we have to think about COVID and the kind of this outlier event, right? We've had our labor market has gotten shrunk after COVID, and there's a high demand for workers, and so that maybe what we're seeing is manufacturers are, putting on more overtime because they have a limited amount of workers. They're trying to catch up on the supply chain part. New orders, ISM, capital good new orders. Again, for most of the year, we've saw that these have held strong, right? As the market is trying to catch up with, how it gotten behind from the COVID situation. But in recent weeks and recent months, these ones have actually turned down. Consumer sentiment, you think about your own personal experience. That's kind of the way I invest. How do you look at the market? Personally, I kind of bearish on the market. I'm kind of bearish I see a lot of my friends are losing jobs. I see the cost of goods around me are getting more and more expensive. It's more difficult making ends meet. So my sentiment is a little bit negative. The yield curve. Now, of all the economic indicators that are these leading economic indicators, I think the yield curve is one of the ones that we'll look at going forward. That's going to give us that clue to allow us to look at those high growth cyclical stocks as the market bottoms. So here's a chart of our 10-year Treasury note yield, and there's the symbol up here. But what I did was I created an expression. I did the 10-year note versus the 2-year note yield. And if you don't know how to do that, we have a FX expression button up here, and you can click on that. And there's the formula for this particular chart. But we do offer you some pre-designed popular expressions, and there you can see there is the 10-year and the 2-year note expression. And so that's what we see here, right? We see a downsloping yield curve, and this is not a good sign for economic cycle. We want to see an upsloping yield curve. And where I'm thinking about for the leading economic indicators on this particular point is we are in an inverted yield curve, which is a sign that the market is anticipating a recession. So I'm not going to be keen about looking for that next market cycle, that next economic cycle, until we get this yield curve out of inversion and get it back above the zero line. In other words, where long-term investment is starting to see growth, right? Starting to see that there's more value in the longer run. That's the point. I think that's the economic indicator we're going to use to help us find that next leg up when the market bottoms, when it gives us time or the opportunity or the word permission to start looking at that next sector rotation. Again, we're probably not there. Stock prices. I know that sounds obvious, right? But the stock market really is, again, a leading economic indicator. And until we break this bear market downtrend, again, I'm not really ready to jump into looking at those forward sectors. Unemployment claims makes sense, right? If we see a lot of people who are going on unemployment, that's not a sign of a healthy economy. We see unemployment claims fall, that's a sign that the economy is a little better. New building permits. And then leading credit index. Coincidental economic indicators. These are the ones that are kind of telling us what's going on now. Retail sales, again, one of those economic data points throughout the year that has been quite confusing, especially in terms of what the Fed is looking at. So when you think about retail sales, you see a lot of corporations or a lot of retail companies are saying, hey, our retail sales are good, our sales are fine, or they're up from the year before. But then when we look behind them, we see that they're not selling as many units. So that might be more about an inflationary story, right? The cost of a unit has gotten more expensive for the consumer, but that's why retail sales has been strong, but maybe not as strong as we'd like. Non-farm payrolls, again, these are in the economic indicators that we get constantly. Personal income, industrial production and utilization capacity. This one in recent weeks, recent months has actually started to turn down. So again, coincidental economic indicators kind of telling us that the economy is slowing. And then lagging economic indicators. Now, what frustrates me a lot is I hear a lot of investors look at these ones a lot, and they make their investment decisions based on these ones that happen after the fact. And that's why I'm really more a fan of looking at those leading economics. But let's look at some of these. We have average prime rate, right? Banks are usually slow to raise rates. They're always a little bit behind the curve. The ratio of consumer credit to personal income. I don't know if you've been watching this one. I have. Consumer credit is at the highest. It's actually the highest it's been in history, but it's higher than it was in 2008 before the GFC, the Great Financial Crisis. CPI, we get that a lot, right? Inventory to sales ratio, very good. Lagging economic. This kind of tells you that the health of businesses. And there's a couple other ones: commercial loans, industrial loans. When times get tough, uh, industries, they have to go into the credit market to help them make ends meet, just like a consumer does. Unit labor costs and average duration of unemployment. So these are other economic indicators we can look at as we make that decision of where we are in the market cycle and where we are in the economic cycle. Okay, so let's do this. Let's have some fun. It is our last session of the year, so I wanted to do a couple things with you guys. So I'm going to go to our stock screener. I think this is one of our most powerful tools on our website. And let's just, now we got the clues, right? We know where we are. We know what sectors we want to look for. So what did we say? Well, we're going to look at we said we want to look at staples, consumer staples, finance, healthcare, and utilities. All right, that's our jumping off point. Next, what I'm going to do is I want to look at, let's have some fun. Let's go and look at market cap. And I'm going to stay away from the mega caps right now because a lot of them are struggling. Tesla, Amazon, Google, those ones are struggling, right? Let's stay with kind of those large cap, more of our blue chip type stocks. Then let's think about beta, right? Connor said that let's look for those low beta stocks, those non-cyclical stocks. So let's add beta and let's go for our medium to low at 1 or below. And then what else can we think about? How about let's look for value. So how do we kind of look for value? There's a lot of ways we can look for value, but one thing I'm thinking about is a price to earning ratio. And what's the kind of the rule? Something less than what, 20? Let's go 20 or lower. And then finally, let's say, okay, I want to see, not only do I want to see these stocks, but I want to see which one of these stocks is actually doing well. And so how can I do that? Well, let's think about some kind of income statement measurement. Maybe we could look at net income growth. And let's just look over the last quarter, last 3 months. And let's look for good growth, right? And what do we get? Let's kind of just search on this. All right, 64 stocks, right? That's not a lot to look at. So what I would do here now is now these are the stocks that are in the right sector that have some metrics that I've already decided, fundamental metrics. And let's look at the performances. And again, we could just look at, let's say, the last month. And which ones? So in the last month, about half of them are, outperforming. If we do it for the last 3 months, again, there's a lot of good stocks in here, right? And look at some of these stocks, healthcare, right? Some financials, insurance, right? Those are the ones that we were sorting on, our consumer staples, right? And there's no real crazy stocks in here, right? No technical stocks. Obviously, we didn't screen for them, but very consistent blue chip type of stocks. So what I would do then at this point is here's kind of my shopping list. This is where I'm going to start doing my other analysis, right? I'll do my charts, right? I'll do whatever metrics you use. I want to do look and see the health of the company. Do I believe that this company has pricing power? Are they in the right part of the economy that is going to do well, even in an economic downturn? And what I might do is save this as a list, a watch list. And so what I've been doing for the last couple of weeks or so is I have been creating this list based on this sector rotation. And this is a tease for you guys, is that not next week's, but the first session we're going to do in the beginning of the year, I'm going to take this list of stocks that I've been kind of just picking through, and I'm going to boil them down and look for those that are going to, I believe, that are going to outperform in 2023. So that's a little tease for you, but it just, you can see some very, very broad-based, common companies that we're all familiar with. All right. All right. So that's one little cool thing that we can do. Now, let's think about, again, moving forward. So let's go back to our stock screener. And again, maybe the timing is not right, but I just wanted to kind of go through this with you. So let's say we get that yield curve inversion out of inversion. So what is the next group that we want to look at? Well, the next group we want to look at as we come out is our cyclicals, right? Our technology stocks. Well, what are our cyclicals? Our consumer discretionaries, right? And our services, our financials, our industrials, technology stocks, high growth, our high beta stocks. So let's do computers, discretionaries, and let's pick one more. Industrials. All right. I want a higher beta, right? I'm going to look at growth. And now we look for maybe stocks at growth stocks. So I'm willing to have a little bit of higher PE ratio. So maybe I'll do a PE ratio of above 20 or somewhere between 10 and 30. And let's get rid of the little caps. And what do we get? Well, we get 220. Probably let's add one more. Let's make I'm just having fun here. Key stats. Let's look at our large caps again. That'll probably get us down. Yeah, about 60 stocks or so. Okay. So this would be my shopping list, right? I'm not ready to buy these stocks, but these are the stocks that I'm going to start looking at when I see the clues from the economic indicators, when I see the clues from the stock market, when I see the clues from sector rotation. These are the stocks that I'm going to start picking from, because those are the ones that are going to outperform in the next 3 to 6 months. Okay. So how are we doing here? Okay, perfect. Right on time. So I want to stop here and answer a couple of your questions, Gene. So give me a second. I want to look at a couple of these questions, and then we'll finish up with one more takeaway. All right?
Sure. And while John is reviewing questions, let me take a moment to let everybody know that some of the tools that John is showing you, like the stock screener, you need a bar chart account in order to run a screener, and we have different levels of membership. A free account is going to allow you to do the certain types of screening that John is showing you. A bar chart premier account, we offer a free 30-day trial on that, and that opens up a whole wide range of advanced screening capabilities that you can use. So if you have not tried Premier, I would go ahead and certainly encourage you to sign up for that free 30-day trial. There's no obligation, and I think you'll find a lot of value in doing that. A couple other people have been asking, is there a replay of the session? Yes, you will get an email a little bit later on this afternoon with a link to the recording. We do have a webinar archive page that maybe toward the end of the session, John will take us there and show it to us. We also have a YouTube page where all of our webinars are posted. There's the archived webinar page that John is showing you. It's in the Learn menu, archived webinars. Okay, back to you, John.
And also, Gene, I want to add that, those charts that I put up and those leading economic indicators, those will be referenced. Those will also be attached to the webinar. So you can look at those, and you can come back and visit them. So you have those as a reference material as well. All right, so a couple of questions that came up is, first of all, how long do these cycles, sectors last? Well, that's a really great question. We knew that we'd they all be millionaires. But let's look at the example of energy. Energy has been an outperformer for a whole year. What is the theory of momentum theory or sector rotation momentum theory? That markets that outperform for 3 to 6 months will outperform again for another 3 to 6 months. So in that essence, 6 to 12 months. Remember, Murphy says the market is always looking 6 to 9 months ahead. So as those conditions become prevalent, right, the market is starting to think about it already 6 months ahead, and then the economic cycle comes, and so that carries through for the next 6 to 9 months. Now, there's no timetable. We don't know, right? A bear market could go on for 2 or 3 years, right? Bull markets go on. We just had a bull market that went on for practically a decade. So the time frame is hard to pin down, but I would say that it's easier to pick a time frame when you start to see changes in those leading economic indicators. So, this cycle, I don't know. I'm thinking maybe through all of 2023. Wayne asked a question. Hey, Wayne, how's it going? One of my regulars. Wayne asked a question about the gold and silver. Wayne, I'm going to hold that. Maybe we might do that in our market on close, but that is definitely going to be part of our analysis in our show in the beginning of the year. And then Wayne is also asking about agricultures as well. So we do get a question here about the difference between the 2-year note and the 3-year note yield curve. And so, yeah, there are some economic or economists that look at the really short-term notes, let's say the 3-month note versus the 10-year note. And again, if it's inverted, it's still the same indication in terms of potential recession. I haven't looked at that one recently, but again, I'm more concerned about if we're in inversion or not inversion. And again, talk about lag time, usually that is about 3 to 6 months ahead of time. So once we get to a flat yield curve or we get to a positive yield curve, it still might be another 3 to 6 months before the market actually starts to pick up, or the economy starts to pick up for that as well. Okay. Jay asks, do I know of any performance data using this strategy? Yeah, I think, Jay, just Google it. You look at John Murphy's. I know some of our competitors go into some of that market detail. And what's it, the AAII, the investors sentiment, the one that breaks out the investment sentiment, investor sentiment indicator, that they have a lot of performance data. You can look at these sector rotational pieces of information. Okay. All right. Yeah, I'm not going to do a crypto one today. I'm sorry. Okay, so let's do this. Let's finish up, Gene, because I know everybody's got to get out there and finish their Christmas shopping, right? Well, maybe. Okay. All right, so a couple takeaways here. First, we're going to assess the general health of the economy, right? The robustness or lack of it. And how are we going to do that? Well, we're going to look at those leading, coincidental, and our lagging indicators. Those are going to give us that information. That's going to help us define where we are in our market cycle and our economic cycle. Second, once we've determined that, right, the health of our economy, that is the clue. Where are we? Are we in the expansion phase? Are we in the recovery phase? Are we in early recession? Are we in full recession? If we did our analysis right now, I think we can all agree that we're peak past full recovery, and we're probably in that early recession. Are we in full recession? I don't think so, not yet. Third, we're going to focus on those sectors that are outperforming in the current cycle and with our coming market cycle. Excuse me. Remember that the market is always looking forward, right? About 6 to 9 months. So where are we? Well, we were in that both the bear market and the downturn in the economic cycle. So what are the sectors that we want to look at? Healthcare, consumer staples, insurance, utilities, right? And those are the ones that are starting to outperform. And then finally, once we define what sectors that we're going to concentrate on, then we can go into the industry groups. We can go into each one of these sectors. We can look at those stocks, see which ones are the ones that are outperforming. And then that's where, as an individual investor, you can start adding those other metrics that you're going to use to help you define which stocks are the ones that you want to invest into. Okay, so I hope you guys enjoyed that. I think it was a little bit of a high, base level, but this top-down market analysis, what clues we can use, how can we apply them to our process, and some of the tools that we have at Bar Chart to help you with that. Okay, Gene, have I forgotten anything? No, I think we don't have a session next week, right?
That's correct. No session next week.
No session next week. Thank you.
We are going to wait until we're into a new year and then start it off with a bang.
Yes, we're going to start out the next year. Like I said, we're going to take this list that I've been putting together, and I'm going to give you guys my picks, so to speak, for our at least opportunities I think that'll present themselves coming in the following year. And I will also tease you guys is, we have a lot of great shows coming up next year. I know Jean's part of that process, and she'll agree with me that some really cool stuff is coming down the pipe. Those of us who are premium members, I want to remind you that this Friday will be our last Market on Close show, and you can see it up here. If you're not a premium member and you want to know what that is all about, again, Jean pointed out, we do have a free 30-day trial membership, and you can come in and check out what's going on in our Friday Market on Close shows. Okay, until then, Jean, great year. Thank you so much for all the help you do. I wish you a safe and healthy holidays. For everybody out there, from Jean and me and from the whole Bar Chart family, have a safe and healthy holiday season and the good of all trading.